traded funds, if you've heard me talk about volatility, that every stock should come with a volatility rating next to it, because too many investors just ignore volatility. As we've spoken about, the bigger stocks tend to be less volatile. Telstra is one of the least volatile, great income stock, but also Telstra and the four banks, they all have volatility measures which suggest they move about 1 to 3% on average, top to bottom a day. And therefore, they are good sleep at night stocks. Now, that's stocks. If you really want to take the volatility out of your investing, if you really want to sleep at night, you don't want to be kept awake, you don't want any stress, you don't want to wake up to find a set of results has come out and your investment has dropped 10 to 20%, there is one obvious solution, and that solution is exchange traded funds. I'm not a BDM for BetterShares or iShares or Global X, but it does make sense these days. Now we have access to exchange traded funds to take the individual stock risk out of investing, to take the results risk out of investing, the announcements risk out, and to take the volatility out simply by investing in a group of stocks rather than one stock. So if you were to put the ASX 200 exchange traded funds into the mix, you're investing in 200 stocks. If you average the movements of 200 stocks, you're going to get less volatility than you will in almost any single stock at all, because you're averaging 200 stocks. So if one goes up a lot, the other goes down, the net result is close to zero. Exchange traded funds, particularly passive exchange traded funds, which means they represent an index or an asset class or a sector. If you invest in a passive fund which doesn't have a fund manager trying to be clever attached to it, if you invest in a passive fund that, say, represents the ASX 500 or not the ASX 500, the S&P 500 or the ASX 200, then you're looking at the volatility of 500 stocks or 200 stocks. And a lot of people are just trying to get the average. They're just trying to get the ASX 200 by investing in 20 stocks. By so doing, they're taking a lot of risk in those individual stocks, whereas you can just buy an exchange traded fund that represents the ASX 200, which is what you're trying to achieve in the 20 stocks that you've bought, and yet your volatility is going to be lower. So the exchange traded fund market is growing every year. It's growing very fast, and there's a reason it's growing fast. It's because people want less risk, less volatility, and they want the average, and that's what exchange traded funds will give you.